Good afternoon, everyone, and welcome to Compeer's Clients View webinar. And first, I must thank our partners, Contemi and Refinitiv, for their support of the running of this particular webinar. Now, over the past 12 months or so, throughout our series of webinars and presentations, we've largely sung the praises of the wealth management firms, especially given how well they have adapted during the COVID-19 crisis. For example, by delivering record levels of assets, record levels of revenues, albeit at smaller profit margins than we've seen in previous years. So with the rise in asset values and strong levels of inflows, one may assume that on the whole, the satisfaction levels from clients will be high. However, what we've found from end investor research over the years is that there continues to be areas of weaknesses among the wealth management providers of these individuals. And also it's inevitable that the investor attitudes will have been impacted over the past 24 months, given what has happened across the world and with the high levels of market volatility. And so therefore today, a focus of our webinar is on these investor attitudes. So we're going to look at how and why these attitudes have changed in recent years, and also potentially where they might be moving to in the upcoming years. Now, the format of the webinar is we've got two presentations to start, and then we'll finish with a wealth management panel discussion. And so without further ado, I'm delighted to introduce our first speaker. And so that is my colleague, Tom Thwaites, who's going to be going through some of the key findings from over 5 years worth of investor surveys. So very much welcome, Tom, and over to you.
Thanks, James, and thank you all for joining us today. So as James mentioned, I'll be running through some of the results from our end investor research to explain some of the major changes that we've seen within client expectations. The data used is from our annual research and covers over 7,000 wealth management clients, stretching over up to 8 years. So my slides will be quite heavy on some of the stats, but don't worry if you miss any, because a copy will be sent out to you all after the webinar. And so if we move on to my first slide, we can take a look at some of the attitudes to clients towards the industry. Now, we all know the foundations between any wealth manager and their clients should be built on trust. But how much trust do clients have with their wealth managers? Well, if we look at the first graph here, we can see that client trust in the industry has been increasing each year. Now, there are dozens of reasons as to why, and first and foremost, we can credit a large amount of this towards the regulation, which promotes transparency and aims to reduce any foul play. MiFID II is a great example here, and the policy of best execution. But on top of this, we can consider how easy it is for clients to access information about a wealth manager nowadays. Within just a few clicks, they can find reviews about the firm, their services, or their staff. Also, key to building trust with clients is to make sure their interests are at the heart of your service offering. If we look at the second graph here, we see a similar outcome as the first. Following the light blue line, we can see the proportion of clients who agree that wealth managers can be described as client-centric has almost doubled since 2014 to just over 60%. And while there is still a large proportion who responded neutrally to this statement, the number who flat out disagree has more than halved. And on my next slide here, we can look more closely at exactly how clients feel towards their current provider. So we ask clients to evaluate their current provider across these key areas, with the results shown in order from areas of excellence to those which have been rated poorly. And top of the list, we have the overall reputation of the firm, which is good news for an industry that relies so heavily on this to generate new business. Alongside this, the access and politeness of client-facing staff were consistently rated highly. However, clients voted less kindly towards the overall responsiveness of employees. And despite being bottom of the list, scores for marketing material have increased the most over the last 3 years, showing firms' efforts here are certainly moving in the right direction. And as my upcoming slides will show, the power of the brand for individual firms is falling. So marketing departments have an excellent opportunity to demonstrate their firm's capabilities and bring in new business. So on my next slide, we can see more detail about which areas in particular clients want to see improved. As I say, some of these areas will be easier to remedy than others. And on screen here are the 5 areas in which clients ask for improvements in the most. The percentages represent the average number of clients who requested either a significant or very significant changes in each of the last 5 years. And firstly, the most requested area for improvement is in the reporting process. Now, despite firms' best efforts to develop this, there still seems to be a bit of a disconnect between what is delivered and what clients want to see when it comes to reporting the outcomes of their portfolio. As a common pain point across the industry, many struggle to find the balance between what should be standardized and what should be bespoke in the fight between efficiency and quality. On top of this, as ESG becomes more mainstream, the reporting process will have to evolve further as it becomes more critical to find an effective way to communicate ESG outcomes to the client without losing them in the data and just confusing them with jargon. On the popularity of ESG itself, since 2016, we've seen the proportion of clients asking for improvements to ESG services has doubled. Now, the second most requested area for improvement has been for more formal client surveys. And as the most straightforward and easiest of all of these factors to fix, it's a surprise to see this so highly on the list each year. But then I suppose if you aren't consistently running client surveys, then how will you know what your clients really want? And finally, if we look at the onboarding, one of the major issues in the wealth sector is that although new clients can be sourced, the onboarding process can be very slow, unlike other financial services where it can be almost instant. Often regulation is a big cause for this delay, but a lot of the time it is also due to the way the processes are structured and the technology supporting them. Our research shows that only 2% of front office professionals believe that their firm's onboarding process is entirely automated. But in contrast, we found that 19% believe it to be entirely manual. So moving on to my next slide here, and we can see how these changes translate into value for money. Now, investment performance and client satisfaction will always be highly correlated. And despite the industry's bouncing back from the initial market downturn last year, many clients will have scrutinized the performance of their wealth manager much more so than normal during the pandemic. As a result of this and other factors which have caused client expectations to evolve quite rapidly in the last 2 years, we found that a lot of clients are more unsettled and looking to move. What we typically find here is that anywhere between 10 and 15% respond that they are likely to change. However, in 2021, this number has jumped up to 38%. And when we compare this across demographics, we find these figures jump even higher. For millennial clients, who represent the future of many of your businesses, 49% of them are open to the idea of switching, while the most concerning stat relates to the high net worth clients, of which 48% are likely to change provider. When we ask clients for the main reason as to why they switch, there was no clear standout answer. It appears a lack of perceived quality across a combination of these reasons is why they want to switch. It's not specifically located to one of the points in the following table. So to focus more on the question of today's webinar, in my next slide, we can look at exactly how client expectations have evolved. So the table here summarizes the key components clients value the most when they're selecting a wealth provider, with the percentages representing the popularity of each factor. And what we find is that back in 2014, clients were much more focused on a few select factors. The investment performance, brand reputation, and fees charged were by far the dominant areas which made up an investor's mind. Now we tend to find that clients weigh up each of these much more closely. So investment performance will always be king. After all, it's why many seek out professional advice. But the dominance of this factor has still been diminished in popularity in this short period of time. The biggest change comes from the reliance on reputation of the firm and the decline in the power of the brand. Clients now seem less interested in the firm's brand and instead consider more factors regarding the quality of service they will receive and the relationship with the main point of contact. As my previous slide showed, the reporting process and available technology have significantly grown in popularity and now play a much bigger part in the client's decision-making process. The past 2 years especially, everyone has seen the rise in importance for digital as clients look for greater access to their wealth manager. And on my final slide here, we can take a look at the impact of COVID and the pandemic upon client expectations. But if we go back one slide, forward one. Next slide, please. So intuitively, you may have expected satisfaction levels to decline without the ability to meet clients in person and with the increased market volatility. However, this has not necessarily been the case. Overall, firms have been successful in their efforts to guide clients through the storm. With the uptake in digital services, 55% of clients said they've had more access to their advisor during the lockdown periods. And despite the dip in performance, 54% said they agree, and 22% said they strongly agree that their wealth manager has kept them on track with their personal goals and targets. Now, the figures in my previous slide have shown that over the last decade, demand for digital has been growing. Internally, for wealth managers, IT non-staff costs rose 24% this year, which will hopefully propel the digital services across the industry, and goes hand in hand with my final chart here, which shows that throughout the pandemic, 61% of clients now place more importance on digital services than they did before. Now, a few of the figures I've shown may indicate that a lot of clients are unhappy with how their wealth manager is performing, especially the stats showing the number of clients looking to switch provider. But to finish on a more positive note, my last stat is a good sign for the industry. Now, purely based on the performance throughout the pandemic, we found that 86% of clients would recommend their wealth manager to a friend. So on that note, I would like to thank you all once again for joining us today. I hope you all enjoy the rest of the webinar. And now I'll pass back over to James.
Thank you very much, Tom. And just to reiterate what Tom said, that we will be sharing all of these slides with you. So by no means are we expecting you to memorize all of the stats that Tom has kindly shared with you today. We'll now move on to our second presentation, and I am delighted to welcome Kian Williams from Contemi, and he is going to be analysing the digital experiences that you're seeing with customers. Very much welcome, Kian, and over to you.
Okay, thank you, James. Hopefully you can hear me clearly. I'd just like to say good afternoon to everybody here, and thanks very much to the whole Compeer team for a well-organised webinar, Maya, Tom and James. To introduce myself, James just has, but my name is Kian Williams. I'm the Global Head of Operations from Contemi Solutions. I've been in financial services, broker and wealth management space for over 34 years. I know the picture on here suggests that I have youthful good looks, but this is a true fact. I have been around for a long time. For the last 20 years, I've worked in financial services from an IT and a systems perspective. And importantly, from the context of this presentation, however, I'm a client of firms like yourselves and others in the wider wealth management community. Next slide, please. So today, I'll be talking about clients' digital expectations from their advisors. And then I guess you can decide if you are meeting those expectations or not. If not, what could you be doing differently? I do, of course, have some research-backed insights, not as many as Tom, but I'm definitely trying to complement what Tom has just presented. I'm not a renowned expert in the field. I'm very much an interested party in how this could evolve. Next slide, please. So before we dive into client expectations, let's have a quick look at your customer types. I hope you would agree that your client base includes all four of these generations. I would like to say I fit into the millennial category, but you probably won't believe it. That's a second joke about my age. But unfortunately, I'm Gen X, and I will talk about it from this perspective. However, I also live with my 75-year-old father, a boomer. And I can give you his boomer insight, but it actually isn't that different from that you would expect from a millennial or a Gen X. He frequently moans at me about apps, and as a result, switches homes for his money. I guess that could surprise you, and suggest all four categories are voting with their feet. Perhaps he should be giving this presentation, but I wouldn't want you to subject you to his language. For me, it's like a living Harry Enfield sketch every day. So currently, boomers and Gen Xers control more wealth and are living longer lives. Gen X are in their peak earnings window and are the core of the mass affluent market that wealth managers need to maintain and grow. Next in line, of course, is the millennials. You have heard this before, but according to Forbes, an estimated $30 trillion of wealth will be transferred from the baby boomers to Gen X and millennials over the coming decade. In the spirit of keeping my dad in this presentation, I hope that will not be the case for me, and he sticks around to give me his digital application advice for many years to come. Unlike boomers, where the current wealth sits, Gen X and millennials have grown up with technology. From game consoles to smartphones, these generations manage their lives digitally. They grew up with the internet. Instead of taxis, they use Uber. Instead of TV, they listen to podcasts, watch videos, they watch Netflix, and they even game online. And when it comes to investing, they prefer self-service apps. So what are each generation of these clients expecting from you, their advisors? Next slide, please. Well, clients, regardless of generation, want transparency, personalization, speed of service, and ease of use. Yes, Dad again, but I can tell you he doesn't like the Outlook app. He prefers Google Calendar. And he's currently looking for a bank with an app that allows him to pay checks in so that he doesn't have to get out of his chair. The two high street giants that he banks with do not provide this, but Barclays do. Why is this? And if you have any influence, please help me, else I have to hear about this every day, and it will allow Dad to watch 24/7 cricket. But you don't have to take my word for it. A recent survey of 2,325 investors across prosperity, ages, locations proved it. Here's what they found. 49% of investors say acting in their best interest is the most effective way for advisors to build a relationship with them. 58% of investors want personalized financial planning. So perhaps Robo's gone. 40% of investors say digital is a great priority, but I guess that leaves 60% who do not. Too many firms are succumbing to the impulse that they must rush immediately to the perceived demands of millennials. While millennials can't be ignored, the industry needs to consider the similar demands and much larger opportunity presented by Generation X, me, and Boomers' Dad. A recent research also found strong interest among Gen Xers and Boomers for increasing communication via text and even video chat, with nearly 50% of respondents indicating that they would use these platforms if they were available. We have become a very lazy generation. If you fail to make it easy, we will not bother, and you have just lost us, possibly forever, regardless of your financial performance. And I think with Tom's statistics there, you saw that there's a lot of different reasons for people leaving, and financial performance stays fairly steady. It turns out that the wealthy boomers look for a very similar experience to what their millennial grandchildren expect, including fast transactions, transparency, and mobile first. And thanks to emerging technology, it's not hard nor complicated to deliver on all of these. Next slide, please. So we talked about clients' expectations, and you can decide if you are meeting these. But let's look at the reality. The reality is that while digital is one of the top 3 reasons to choose a wealth manager, customers are not happy with their digital experience. Various surveys have highlighted the disconnect between what advisors think their clients want and the reality of the situation. We found that advisors significantly underestimated the digital prowess and expectations of their clients across generations. Only 37% give their wealth manager a top mark for digital experience. To be honest, I think 37% is actually quite high. 25% will consider switching from you based on that dissatisfaction. It is now possible with API technology to aggregate all of our wealth from different places. However, 44% remain sure that they do not get this. Next slide, please. Some advisors provide a client portal and they think they are meeting the digital experience expectations. It's not as simple as creating a shiny mobile app that allows your customers to check on their portfolio, to check potential changes since the day before. It requires a complete reinvention of the client experience. How do you onboard customers? How do you request documents? How do financial advisors interact? Do you have a conversational UI? And on and on. User-friendly interfaces across the wealth management space ensure that even the least tech-savvy customers, regardless of the generation gap, can benefit from digital solutions. Everyone in the value chain benefits from having one central point of secure collaboration around important information, be it financial advisors, professionals, or family members. The ability to onboard without any human touch points is the potential highest demand of clients. Personally, I would certainly prefer to simply apply for a new account from my armchair. And at worst, I have to get up and fetch my driving license to prove my identity through a camera on my phone. And in Dad's case, he has to pause the cricket to ask me to go and fetch his license. Next slide, please. So what does this mean for advisors? It's very simple. If you invest in digitalization now, it makes you ready for all 4 generations and their evolving needs, even my dad's. Think client experience, whether that be how they interact with your world, but also where their data is and how they can do more with the data from a self-service perspective. Next slide, please. So here's how the shift towards digital holistic advice is paying off for wealth managers. Very similar again to the sort of things that Tom was showing. You can see all relatively similar numbers in terms of return on investment, suggesting all are worthy of that. Digital customer onboarding sits at 27.8%. However, when looking at the ROI, many firms struggle to give it the value unless the volume of new clients or new accounts merit it. But if you were dealing with wealthy people, surely their experience is worth it, regardless of them being 1 in 100 or 1 in 100 million. Next slide, please. So you may or may not be wondering what Contemi's role in all this is. Well, we have a platform called Wealth Intelligence, designed specifically to meet the digital needs of customers across the wealth management lifecycle. From digital onboarding to a self-service simple client portal where it's possible to interface to your wealth manager. My final note, and despite all of the evidence, remember that there is an emotional attachment to money, and this means people still want to be able to talk to people. Technology can just augment that attachment. Just like to say thank you to everybody for listening to my presentation. I hope that I provoked some thoughts. Please add any questions in the chat. James will help me to respond at a later time. I'd just like to say take care and thanks for listening.
Thank you very much, Cian, for that insightful presentation. And so this now brings us on to our panel discussion. And so before I introduce each of our panel members, just a bit of admin. So if you would like to pose a question to the panelists during the session, there's a Q&A button at the bottom of your screens. So please do use that and I'll look to get as many of these questions answered as possible. And so joining me today, I'm delighted to have 3 panelists with me. And so given the first-hand view from the wealth management firms, we have Sasha DeBlitz, the head of marketing at Weberton Investment Management, and Paul Fletcher, the marketing director for wealth businesses within the NatWest Group, including Coots. And then given the supplier's perspective, we have William Ferrand, the global digital wealth director at Refinitiv. So very much welcome to each of you and thank you for your time today. So I'll get cracking with the first question. And Sasha, if we start with you on this one. So what are the biggest differences, if there are in fact any, that you've seen when dealing with clients of different generations? And then the next step being, what sort of steps are you taking to retain your existing clients' wealth, for example, when it is being transferred to the children of your clients?
Thanks, James. I suppose I'd like to start by sort of framing that question really, because when we think about our clients, or clients in the industry are not a homogenous group of people, and even clients within a firm like Weberton aren't all exactly the same, even with their own expectations of our service or what they actually need. So when we think about, how do we deal with different clients or clients of different generations, I don't think it's as easy as saying young people act and think in one way and older people act and think in another way. I just don't think it's as clear cut as that. It depends very much, for instance, on how much wealth we're talking about. That can often have a greater indication of people's expectations and how we look after them than their age or indeed their gender or indeed whether they're part of a family of accounts with us. So it's a much more complex picture, I think, than perhaps it's possible to just draw some sort of simplistic assumptions. But I think when we think about, how do we think about retaining client accounts and the wealth of a family, again, there's no one answer, there's no one silver bullet for that. It will very much depend on the relationship that we have with that family and the type of account and service that they seek from us. I mean, inevitably, like many firms in our space, we do a lot of next gen stuff. So whether that's helping our younger portfolio managers get the experience they need by dealing with younger members of other families. So there's a bit more of a sort of like meeting of minds, if you will. That's very helpful too, in terms of embedding those relationships for the longer term. I mean, most wealth managers will have advisors who've looked after many generations of the same family. So that's all part of that relationship development, if you will. But it depends what the second generation really want. They may want a very different service from what their parents have had. And so we have to make sure we meet those needs as if they were a new client.
Thank you. And Paul, would you agree, or is there any sort of different things you're doing for different generations?
Yeah, I agree with Sasha. So I think clients on the whole are deliciously eclectic. They are, it's too blunt to basically say that younger generations they act in a certain way, older ones do. It's, when we talk about certain themes and we look for some generational difference in terms of engagement, it is actually quite mixed, particularly on things like ESG and sustainability, for example. But what you can point to is that younger clients in particular are driven by purpose and values driven companies. They're more predisposed to giving them business. They tend to be much more loyal towards those, and we have seen that as a trend that's coming through. And I think in recognition of that, we have looked at both the emotional and rational ways in which we engage a younger audience. So that 35 to 45 next gen, when everyone says next gen, they always think they're going to be in the 18 to 25 bracket. They're not. The vast majority of them are going to be the 35 to 45. They tend to be people like me. They like to race this. They went out in the 90s drinking, and they're a lot younger than people think that they are, right? So if you think about it through that lens, for me though, that audience is a very important audience anyway, the 35 to 45, because if you look at it like other organizations such as Adidas, for example, they will have a certain type of range or product that's right for that audience that stays permanent youth. So Adidas have their originals, for example, that's been permanently useful for 50 odd years. So for us, it's about how do we make ourselves relevant to those 35 to 45-year-olds, because those are the ones, particularly right now, they're going to be the partners who come into carry. They're going to be the digital entrepreneurs that are getting younger and younger. And it's also different types of entrepreneurs than you might have seen previously. So we look at it as a sort of a win-win, whereas if we can acquire clients at that level, firstly, it's going to actually replenish our client base anyway. And secondly, we know that it's going to work for the next generation. Now, given the fact that we know that they're values driven, we've become a B Corp. So that's external verification of the way in which we do business, so an external referee. And that was in addition to UNPRI work that we've been doing. Our positioning is focused on sustainable luxury. So if you look at us from a semiotics perspective and how we present ourselves, everything's geared towards focusing on ESG, focusing on a younger demographic, and focusing on that luxury positioning. And for more of a rational engagement with these types of customers, we recognize that when we launched our first app, it was the first one of its in the sector. We are actually now going to the next stage of that. So it's about providing optionality through what we call Bank in the App, which we're going to be launching next year, within the next 12 months. And and it's going to provide much more optionality for those types of customers that might want to engage with us digitally versus face to face, and having the option to do either.
Thank you, Paul. And William, if I slightly rephrase it for you, from your experience with dealing with wealth management firms, is there anything that you've seen that they're doing to ensure that the wealth is retained when it is passed on to the next generation?
Yeah, thanks. Yeah, I think there are a few things that I think are quite interesting that are being done. Because we have seen a sort of huge increase in terms of wealth transfers over COVID, potentially, as people have looked into their mortality, with a morbid start to what I'm saying. But I think that different, and I quite like Keen's approach where he talked about a multi-generation strategy. Different people like to be served in different ways, and understanding the channels through which people want to be served, not generally, but at different stages across their sort of journey, with a wealth manager is key. And to both Sasha and Paul's points, that isn't, you can sort of generalize to a certain extent based on generations, but it is going to vary from one person to the next. But if you can get an understanding of those channels and how people want to be served, across the journey, and which channel will be best at which point, that'll massively help. I think the other thing is that wealth managers are being compared, not necessarily just to their peers anymore, but to this sort of a broader type of company. They've been compared to big tech, to fintechs, etc. We're seeing people saying that they would put money in big tech and fintech. So we need to sort of think, be a bit more forward thinking. And I think some younger generations actually find investing a little bit confusing. They could be self-made, but that if someone is a TikTok star that's self-made, they're not necessarily going to understand investing themselves. And so one of the things that I've seen that's been quite a good approach with some wealth managers is sort of creating that learning and sort of involving multi-generations, teaching them a bit more about financial planning, about investments, etc., and sort of bringing them in so that you're involving everyone from the beginning of the journey. And where we're thinking of wealth transfer, it's not just being seen as the parent's wealth manager that they used, it's sort of bringing everyone into the story from the beginning.
Thank you, Will. Now, one of our listeners commented he understands the point regarding the size of the client, but it might not be too unreasonable to think that all clients wish to be treated equally. So that brings up the question to me. Obviously, delivering value for money is vital. At the same point, the wealth managers firms need to make some form of margin from these services. So first question is, do you believe that the minimum investment levels may need to be increased to access a wealth management firm? And then if not, how do you then deliver value for money and also make healthy margins within the firms? And I'll start with Paul on this one.
It's a great question. I think all customers and clients should be treated fairly and appropriately. You shouldn't treat all clients the same. We wouldn't be a business if that was the case. And so there needs to be a certain threshold that we have in terms of quality and standards across all clients. But if you differentiate between someone who's giving £1 million versus £100 million, the level of service and complexity, you've got to reflect that in the relationship.
I would agree. I mean, just from a practical point of view, as Paul said, it's a very complex case. If you've got 100 million that could be in all sorts of jurisdictions and multiple structures, is a very different service proposition to somebody who's probably got, I don't know, £200,000 or £300,000, which is a decent pot of money. Let's not. Of course it is, and they deserve all the service that is commensurate with that. But there's a limit to how far you can take it in terms of what you can do for them. It's a bit more of a simple solution for them. So I didn't mean that clients get treated any differently in terms of their value to the business from a relationship point of view, but it's in terms of how we service them and what resources they require. Very different.
Okay, and Will, would you agree, or do you think?
Yeah, I'd agree, and I think that offering different services, based on the investment, is something that is relatively standard and that a lot of people understand. And actually, if you can work with your customers, that may have less to invest and have I guess, a lower tier offering or whatever you'd like to call it to start with, but you can help them to grow their money and become one of those larger investors in due course, that's a great place to be as well.
Thank you. And Sasha, I'll come back to you on this one. So one of the stats that Tom shared was that the likelihood to switch is now as high as 38% of investors that answered our survey. So that's why, is this a concern, and what sort of measures do you need to do to minimize the impact that this could have on you?
So I think it's really interesting to see that number, and from what you were saying, that it's increased dramatically in the last year or two. I suppose if I was just looking at that number in isolation in my business, I'd think, well, I'd quite like to know who it is that is switching. I mean, inevitably, there's an element of moving around in our industry. Okay, we know that happens anyway, whatever the economic climate or whatever the players are doing at the time. That is quite a natural level of I want to say churn, but I'm not sure we're allowed to use that word anymore. But I'd like to know who's switching in and out. I mean, we've talked about the industry here in very sort of generic terms, but within wealth planning or wealth management, there are so many different types of players. So if you've got people who are only seeking an online service, and it is very easy, therefore, to switch in and out, I'm not surprised there's a higher level for those people. Where you've got relationships which are much deeper and richer and what we would call more stickier money, i.e. we've got a full wealth planning service, we perhaps look after a complex suite of accounts across a large family, that money those accounts are very difficult to move. I'm not saying that people don't sometimes wish to change provider, but it's a very laborious and sometimes quite challenging process to move from one provider to another. So I think it would be useful to unpick that number and say, who is it that's actually saying that, we'd quite like to move, or we would move quite regularly, because I suspect it's more to do with the type of account they're seeking and the kind of service that they have, as opposed to it being a flat 38% across all types of wealth management. I don't know, Paul, what do you think?
Look, I think there's quite a lot of, I agree on it as well. I think there's quite a lot of platform tourism, and we see that at the moment, where our clients will trial something and they'll create, they'll invest in a certain type of platform, etc., etc. I think 40% is very high. I'm quite surprised by that. So that is quite worrying for an industry, particularly as it's going in a certain way. And it just shows that there's going to be quite a lot of flux with a lot of the digital investing coming through. But I still think that simplicity, single fee, single strategy, and consolidation will continue to be a role, and you'll see lots of people playing around with different platforms. We've definitely seen that, but then we also see that quite a lot of those that they utilize these for certain purposes, and then when it gets too complicated, they consolidate.
Okay, so we mentioned digital a couple of times there. So come to you now, Will. In terms of the digital services and how they've expanded and improved in the last couple of years, how do you think they're going to evolve in the next 2 years? And then how do you then manage client expectations to ensure that they are really feeling they're getting value for money because of these digital investments?
Yeah, it's an interesting one. And I think that, I read some research that said 29% of technology actually has reduced personalization in the last year. And we saw in the research that Tom presented earlier, actually, that people have seen a drop in client centricity in the last year, even though that trend has been upwards overall. So I think in terms of digitalization, there are certain things that we can do. One is using data, internal data as well as possible to better understand our customers, better understand their preferences, what they've invested in the past, etc., so that that sort of personalization can increase, because I think hyper personalization is something that is a trend that's going to continue to increase. I think within digital tools, yet again, different ways of serving the customer, that's something that we've seen a big increase in, but actually increase in the productivity of wealth managers is potentially the next area. Most wealth managers are logging into 6 or 7 different applications that don't really talk to each other every morning. As we go more towards, having better APIs, etc., and tools, and what I'm seeing with a lot of customers is that they want their tools to link better together so that if someone sees a piece of news on particular investments, they can see immediately, who are the clients that are going to be impacted by this, and they can sort of front run potential calls, look at different thematics, what's happening in the world, who are the clients that are going to be of interest. And that can also be done from a lead generation perspective for attracting new customers. So I think linking the different tools together, CRM systems, portfolio management systems, etc., financial planning tools, to sort of have a single cockpit view for wealth managers will hugely help them in terms of A, their productivity, and B, personalizing the offer and sort of being a bit closer to their customers.
Okay, Sasha, do you agree? Or there are
No, I do. And I just think it's so interesting the way we use these labels, because, back in the day, digitization was all, about personalization. And actually now we're just talking about personalization, including the sort of high tech and high touch service. Personalization doesn't necessarily equate to, heavy investment technology and it's all online. I'm not saying that's not something that happens in terms of personalization, but, having a phone call from the person who looks after your account and then maybe having lunch with you, that's personalization right there, without any investment in technology. So I think we've got to be quite careful when we talk about trends, what we're actually talking about and what that really means sometimes in reality for the client, and what they actually want. I think increasingly technology and digital services obviously is paramount, and won't be tied to anyone who doesn't invest in that. But certainly for some providers like us, if we were to do that without investing in our people and not continuing to offer that very personal service, which is not digital, at our peril, really, because that's what clients expect from us. And so I think for us, it's a high tech, high touch strategy, as opposed to one or the other.
Okay, and Paul, where do you see digital services going, and how do you ensure they're client-centric?
Yeah, so we focus on personal service, digitally enabled. That's really our mantra. So what that means is that as like all consumers, we're going to become increasingly app driven. So the vast majority of our services you will be able to access via the app, which we call Bank in the App. And that means also that the experience that you receive via the app becomes a lot more symbiotic. And we've focused quite a lot more recently on customer lifetime value and being life cycle focused, and how that affects your contact strategy that you have with us. So essentially, we're starting to move into database of one, and a very specific experience by client. And for us, the acquisition and the deepening of the relationship that we'll have with our clients will increasingly become a lot more prompt driven, and via the app to augment what the bankers are doing themselves. So for us, there's a great opportunity to combine both of these elements in something which is ultimately in keeping with the way that consumers are doing business nowadays. And we've also got that an excellent call center in Creeks 24, which has 98% approval rating, which, and again, if for those clients who don't necessarily want to be completely app driven, there is a telephony service as well that they're able to access. So it's all geared around what the customer ultimately needs and wants.
Sorry to jump in, but I think that's a really good point, Paul, which is that by giving people more information through the app, we're not saying just use the app and you no longer speak to anyone. What you're doing is sort of raising the interactions with their wealth manager, so that the wealth manager can really add value when they're having those interactions, rather than just doing sort of relatively commoditized, basic things.
And we're also looking at, actually we've invested, but we're adding more and more journeys to this thing called Pega, which is essentially always on comms. So what this will enable is, particularly certain types of customer groups, we see their banking, so therefore we know what's happening with their account. If they've received large bonuses, it puts into play a certain journey that will happen that comes off the back of that action. essentially then creating the next best action for the banker, follow up with a phone call, and then advise them. And where this will ultimately go to us, I think, for certain types of our clients who want more and more of this customized experience, will be a Strava type service for clients. That's basically providing really helpful prompts to help them into maximizing their options around their wealth.
Okay, so staying with you, Paul. Now, and going back to one of the other things that Tom brought up about the power of brand and how it may be actually less now than it was a few years back. So, how do you therefore differentiate yourselves from others? Given there's nearly 200 wealth management firms out there, and even more if you include the IFA market. So, how do you therefore make yourself an attractive proposition for prospective clients and make sure they join you rather than another wealth management provider?
So we've set our stall out, and we're investing quite a lot in the brand. So it's quite chasing to find that statistic, but we shouldn't overstate the importance that we have in our customers' minds and what ultimately it takes to achieve cut through. And I think there's been significant underinvestment in brand across the sector to make ourselves much more appealing to consumers. So from this year, we're launching Coutts' first ever full-scale brand campaign, our first TV commercial. We're utilising geo-targeting around certain postcodes through Channel 4, Sky, and other slots to promote ourselves. And I think there is something seductive in being open for business. And I think wealth managers on the whole could probably do that a little bit more. So we're investing a heck of a lot in the brand. A third of the growth that we'll achieve next year will come from digital acquisition. So again, this is going to be supported by performance media and digital acquisition across different platforms. A partnership that we've got with the FT around their wealth publication. And so we're expecting a lot to come through. And I think the other aspect I think that a lot of firms don't take into account is the value that acquisition plays, and start to look at things from a lifetime value perspective. So I'd recommend for anyone listening to this, I would look at the income that you get from acquisition over the course of 10 years. So if attrition is relatively low in your business, and you can see on a per person basis, not just year one return, but actually return that comes back over the course of the 10 years, we're estimating that we're going to be targeting through the whole campaign a 1 year payback with a 10 times multiple at least from the campaign. So, I would recommend people to look again about how they promote themselves and become a little bit more proactive across the industry, because, there's a lot we can do to promote ourselves and become a little bit more straightforward in the way that we do business.
And Sasha, is there anything that Weberton are doing to boost their brand?
Well, yeah, we are actually. We've got some plans for next year, but I would just say that saying that brands are very weak and not a part of the selection process, or it's hard to know who to choose from, and brand doesn't play a part in the selection process. I don't know. I think I'd like to challenge that. I think it probably depends on your brand. There'll be some brands for whom it is a big part of the client's emotional selection process, and for some of them it just won't be, because they're buying on price, or they're buying on another metric which overrides the value of the brand, because maybe the brand in that instance doesn't carry much. So I think it's a bit of a sort of blunt statement to say that brand is increasingly less important. I think probably the fact that Coutts are investing heavily in their brand show that they think the brand is pretty important, and that's a pretty good indicator of where it's at. But I just think increasingly clients aren't that. I don't think that they don't account for brand at all. I think it depends what your brand is. If you've got very strong branding, very strong brand purpose, and very strong reputation, I think that does play a factor. I don't think you could take it completely out of the equation.
I mean, is it almost the case then that it could have weakened from our stats because firms haven't been promoting their brand enough in recent years? So if they turn it around and do start promoting more, then that should hopefully reverse the figures.
I think it's going to be really interesting. I mean, if you see the way in which this is playing out across the industry. You know, you might have seen Aberdeen's more, recent brand campaigns that they've launched in the last couple of weeks around, bringing to life, if you invest in this, you're investing in that. And I think it will be interesting to see how, as asset managers move into more of the wealth management space, and the way that consumers as a whole want to simplify, and they want the digital applications to make their whole wealth management experience a little bit easier. It will be interesting to see how much brand starts to play a role, and you will start to see, as you do in other countries, a lot of wealth management and a lot of asset management promotion across different platforms.
I think increasingly, can I just add one little thing? Sorry. I think as increasingly companies are talking about their purpose and their governance and how they are not just providing an investment service, for example, but what they stand for and the values that they're aligned with their clients. I think brand has sort of got a new lease of life, really. I think perhaps, 10, 20 years ago, it was a bit wallpapery, and, typically wealth management brands were all quite samey. But I think now is a real opportunity for brands and branding to have a new sort of role in the whole marketing mix, and to be much more on the front foot about the value that it brings to the client's experience and selection process. And I think that's a fantastic opportunity.
And Will, do you first of all agree? And is there anything else you think wealth managers could do to boost their brand?
So there's an interesting one. A couple of weeks ago, I went to a conference, and just seeing the different people there showed sort of how all over the place, in a way, things are. You had, in terms of how people were dressed, you had people in suits and ties, from anything from suits and ties to jeans, t-shirt and a jacket and trainers. You had people, in terms of how they presented their companies, talking about when their company was founded and the history of private banking, and up to others talking about their ESG approach. And, to Paul's point earlier about where he was saying Coots presenting themselves and that they're now B company. So you have a complete range of how people are presenting themselves. And to my point earlier, where wealth managers are being compared to, a broader spectrum of company, and there is this sort of experience economy, the fact that Apple, Starbucks, Peloton, I can see a bike behind Paul, have done so well, is because they provide that excellent customer experience. If you break an Apple phone, you can go into an Apple store, you're met by a young, well-dressed, informed person that would probably swap your phone on the spot. That sort of experience and feeling part of a sort of community. And it's something I think some of the fintechs and the self-directed players have done quite well, is used technology, data, social to sort of create a community. I mean, we've seen it, for better or for worse, with Robinhood and all the meme stock stuff. But I think there is still an opportunity, even among high net worth investors, to sort of create that community, for people to feel more of a belonging and be more excited about investing, because that's it. They don't necessarily always think of investing as an exciting thing. And I think that's a big play in terms of the brand. And sorry, just to finish, in terms of the brand piece, in Tom's presentation, the key reasons people switch provider, the number one was recommendation from a friend. So there is still a piece, that is linked to brand there as well.
Yeah, I get just to build on that. I think you raise a really interesting point about the Apple experience, is that you go into Apple and it's going to get sorted there and then. And this is a thing that we found with regards to Coots 24. Our telephony service, which is manned by our bankers. We can deal with 80% of those things there and then. And it will be interesting to see how this plays out in the future, that effectively people are wanting almost like a doctor's surgery experience. And a lot of the sector will not like this, what I'm about to say. But, all your information's there, and you need to know that when you're ringing up, the person knows your name, and you're not having to give them your name multiple times. It's a bit like the dinner party example. If you've had to remind someone of your name 5 or 6 times, you think they don't know you. So you've got to make sure the data piece is absolutely spot on, but it might not necessarily have to be the same relationship manager every single time. And that client director role might be a slightly different role in the future, which will be the front person for specialists coming in who can talk about different aspects. So I wouldn't be surprised that going forward, we end up in a much more matrix-driven structure as we look after wealth.
Thank you, Paul. Now, we've received a comment that ESG is, in fact, obviously driving a big choice with the brand, especially among the newcomers to wealth. And it's obviously a major hot topic. I mean, there's some research that suggested by 2025, I think it's as much as a third of all assets could be invested in ESG. So what sort of changes have you seen in terms of client demands for ESG and also the expectations of clients in this area, and what sort of products that are best suited to meet these demands? And I'll start with you, Paul.
Yeah, so you know, when we look at our clients and we've got quite a big client council, we've got 1,000 clients who are part of our client council, so we always get quite a lot of feedback, you know, on an ongoing basis, and then the actual more specific research that we do. What it comes through is that our clients are aspirational people who want to do well, but they don't necessarily want to do well at the expense of others. So that's I think, in terms of where our clients are at the moment. So I think if I look at us versus some very socially driven, purely socially driven banks like Theodos and others, I think that we're not quite at that point, but we're at the point of where you've got dual benefit of doing well by doing good. And I think the positioning that we have as a bank is, how do we help our clients do well, not inconvenience? That's my kids in the background, so apologies if you can hear that. Our clients will do well, but as a do good as a byproduct of being with us. So we took a decision very early on in our investment approach to put ESG principles throughout all of our investments, so that when someone invests with us, they know that we are doing a good job as from a shareholder perspective to influence how other companies do that. We've done that with Next, Primark, etc. More recently around ethical ways to produce clothing. There's lots of examples of how we've done this, and also confidence in that they're giving us, and what we're then investing, their specific ownership that they have of that company is the right company that's doing a positive thing for society and the environment, and is run really well. So for us, it's around how do we enable, just by being a customer of us, that our clients can feel like they're actually doing something that's good for society. And that goes through our B Corp, goes through our investing from an ESG perspective, goes through green mortgages. Everything that we do now is geared towards that.
Okay, and Will, what are your views in terms of ESG and meeting client expectations in this area?
So it's something where, I mean, some researchers said that a lot of people's sustainability goals, 78% have sustainability goals now, but I think 53% don't think that their wealth manager necessarily understands them. I think that there's a sort of broader aspect to that in terms of education. ESG as a thematic is easier to understand than sort of raw economic data for someone that doesn't have a finance background, but they still struggle to make sense of the ESG data. We provide ESG data, and one of the questions we always get is about inconsistencies in ESG data between different providers, how people report it, etc. So I think getting an understanding of the data, how companies portray themselves from an ESG point of view versus how they're seen from within the news, within social media, etc., from a sentiment point of view, but good comparisons as well. So yes, I think, with ESG, we're making big strides. I think that some of the regulation that's come in, helps a lot, but I still think there's a long way to go in terms of sort of normalizing everything across the industry, to make sure that we're all sort of talking the same language when we talk about ESG.
Sure. And Sasha, is there anything you'd like to add in terms of ESG?
I think that both points are extremely well made, and I agree 100%. I mean, on the one hand, with Paul, I totally agree that centralizing your ESG approach within your investment process is where it's at, right? I mean, frankly, ESG is nothing actually that new. It's really well-informed decision making on the investment process. It shouldn't be something else that happens over there. And actually, I sort of think that it won't be long before the ESG acronym itself is sort of redundant, because why would you have some investments that are managed with really well considered research with regard to those three letters, and then you have some investments over here that you don't bother with? I mean, it just doesn't really make any sense to me. I think ESG is it should just be the way your central investment process is operating, or a big play in the way the investment process is operating. It's not a badge for a product. But also, I think that the point about the industry being in a bit of a muddle, it's very inconsistent to, there's no standardization yet in terms of either the labeling or the way things are measured and the analytics that we get. So I think we're sort of in early stages to make this easier for everybody to understand and adapt to sort of mainstream. Obviously, it's mainstream in terms of the narrative of the industry, but I think we've got to get to a point where it just becomes sort of normalized, and easy for everyone to measure and understand the impact of their investments. At the moment, it's, you know, words like sustainable and ESG will get thrown around, but they're not consistently applied. You know, for some it's a badge, for some it's a process. You know, it's quite different.
And we're in it all the time. And when we look at actual awareness of what ESG means, it's really, really low to person on the street. So, you know, people don't really know what it means yet. And so that it will be interesting to see how that plays out.
Mm.
Okay, well, just noticing the time, I'm going to sadly have to bring this panel discussion to an end. So thank you so much to the three of you for your very detailed and open responses. And also, I'd like to thank our two previous speakers, Kian and Tom, and thank you all for logging in and listening. And thank you also to Contemi and Refinitiv for your support in the running of this webinar. Now, obviously, we've got some upcoming webinars coming up, so if we could just move the slide on one place, please. And so our next one in December has been from our parent company, so they'll be looking at building diversity in the wealth industry, so that's from Parkwell. And then moving to next year, in the early parts, we have our compliance and our wealth tech conferences. So it'd be great to see you guys at those events, or logging on to in case of them being webinars. And full details can be found on the Compeer website. And so thank you once again. And really at this point, I'd just like to wish you all a good night and a fantastic remainder of the year. So, thank you.